Hi everyone, welcome to this panel. We're going to be talking about finance. I'm keen, before we get into specifics, just to get a sort of sense check or a pulse check, if that's the right question, on a Thursday of Climate Week, of how you're assessing the conversations you've been in as they relate to finance. I've met some finance people here who are super depressed, who are saying things like, don't poke the bear, keep your head down, those kind of phrases I've heard. But there are others who are trying to be more pragmatic. Okay, there's a lot of noise, but there's still opportunities, there's still things to do. The issues remain the same. I'm interested, Elodie, maybe I'll ask you first, like, what's your take on the sentiment amongst investors, financiers here?
Hello everyone. So happy to start with this type of question. It's a bit like, is the glass half full or half empty?
Yes.
To me, at this very moment, it's both, actually. This is the point. It's half empty because obviously, I mean, global warming is there. We are at a 1.3 degree. Highest probability leads us to a 3.6 degree by the end of the century. I don't know if you're well positioned as well to observe it, but after years of discussion on transition, this week was all about climate risk, adaptation, resilience. So this is really the testimony that all of us in the ecosystem observe the materialization of the climate change, and now it's actually how we will deal with that. We keep talking on the fact that actually the required investment to match financial needs are not met. And finally, we do know that the geopolitical dynamics is actually increasing uncertainty and alter public policy. So this is the half-empty version of the story, but it's also half full because we can see different things and we are hearing different things. The fact that even if global emission, absolute emission are increasing, it's interesting to see that carbon intensity are following a downward trend. If you look at global indices, it's really something going down, and it was minus 20% for global indices last year. That we have more and more adoption at corporate level of climate objective. More than 60% of the market capitalization in Europe is covered by a climate objective. It's more than 40% for North America, and it's already a bit less than 20% for emerging markets. So this is something happening. And obviously, the growth of clean energy leading to, I would say, competitive positioning is also, for the more mature solution, is a positive element. The last positive element is that in this geopolitical dynamic, it has been said a little bit in the previous panel, actually it created this need for strategic autonomy in terms of energy. This topic is a very important one and very supportive in terms of investment allocation, and it leads to an alignment between climate objective, industrial plan, economic growth. And that is, for me, an important support.
Okay, mixed bag. Sarah, how about you?
Yeah, depending on who I talk to, they're either incredibly depressed this week or very optimistic. And I think it comes down to that divide is some of the investors that I've spoken to who really place bets based on current policy without thinking about long-term strategy, going through the pendulum swings of US politics, are the ones that are most depressed because their thesis has now been blown up. And so they're the ones that are struggling as they're seeing and trying to pick up the pieces and understand how to plan and how to deal with the realities that we have today because of political shifts and energy policy shifts. But those that have been doing this long-term planning and thinking, they're excited, they're optimistic, they see good deals and ideas of what they can do. And as a climate scientist by training, a physical climate scientist that worked most of my career on adaptation and resilience and thinking through strategies to deal with climate change, I'm incredibly optimistic and excited because I'm like, finally we're talking with nuance about adaptation and resilience and all the ways that one can think about how to invest in it, because unlike mitigation with energy, this is across every single sector. So there are opportunities in every sector, in every part of the world to be thinking about this. There's nuance of it, there's discussion of it, and that is what has made me incredibly optimistic about this week, is what I'm seeing in that space. There were glimmers of it in the last few years, but it has really come forward with very serious people talking about it, writing about it, and being prepared to start investing in the space.
Brilliant. Well, we will return to physical risk in a bit, but I was keen to ask you at the top about geopolitics, because I think, as you say, that's kind of partly affecting the mood music. And it was amusing to me, maybe that's not the right word, but I was a little bit tickled to see that last year during Climate Week, you had President Biden celebrating all the achievements that he had his administration had done and throughout his long career on reducing emissions in the US. And the IRA being the sort of exhibit A of that success. And this year you have the US president during Climate Week in UNGA saying various things, that climate change is a con job, I think was his word, and renewable energy is pathetic and a joke. So you have the US, at least at the federal level, pulling in a very different direction. Then you've got China, which is pushing very aggressively on electrification, decarbonization, and sort of seeing that as a strategic imperative to do so. And then you've got Europe, which I know there's sort of regulatory and challenges, bureaucratic stalemate in some cases, but they're still pushing in the same general direction. And so you have this tension between the US on the one hand and other jurisdictions on the other hand. And I guess I wanted to ask you, as global institutions, of course, European asset manager, US bank, but you have global operations. How do you manage that inherent tension between what clients and regulators want in different jurisdictions?
I will say, if anyone wants my very deep thoughts on this, they can go read the report that I put out last week called Power Rewired, how geopolitics is changing the game right now in this new energy security era. I worked with our global head of our Center for Geopolitics to write it, where I see this behavior is firmly rooted in national security. It was starting to bubble up over the last few years after the Russian invasion of Ukraine, after some of the activities we've seen in China in terms of cornering the critical mineral market. But it is now really coming to the forefront, where investors and energy experts in the US are now becoming aware of the importance of national security and driving industrial policy and in driving trade policy now, and how energy is reshaping because of this increase in demand that we're seeing because of AI. And in the US, this seems to be a surprise. I was in Asia last week, and I was having discussions with investors and conglomerates and CEOs about this topic in Singapore, and they're like, yeah, duh. This is what we're planning for. We're planning for energy self-sufficiency. We're planning for differences in trade with critical minerals. And then we're also planning for innovation and for science to be the future of the economy. So I think it's now we can talk about it more clearly, and we see it more clearly, and we see data and the information that we can see how geopolitics is shaping these things. And I think everyone needs to be more aware of this, because that is going to really drive investment in this space, and it's going to drive decarbonization. But really what it is self-sufficiency and countries getting off of geopolitics of the US and the Middle East and driving their own energy future by being able to produce it themselves.
Okay. Well, one way in which I think that the geopolitics conversation becomes most relevant for financial institutions, whether banks or asset managers, is through the lens of client relationships. Been obviously very interesting to see, one example in the US would be the red states and what they did on some of the restricting access to certain banks or investors to kind of manage their pension money or underwrite their debt. And then you've seen kind of the opposite of that in Europe in recent times, where you've seen a large UK asset manager pull money from State Street. Some of that went to Amundi and elsewhere, and that was based on their view of the sustainability credentials of that asset manager. And then you also have seen recently a similar situation in the Netherlands, where money went from BlackRock to some other asset managers based on, again, those asset managers' view of the sustainability and climate sort of commitments and policies of those asset managers. And so I wonder if the geopolitics of people, investors' views of their counterparties' credibility based on the jurisdictions in which they're based is affecting kind of the ability of finance firms to retain clients and attract new ones. Like, do you feel that tension? Do you see that as a risk?
For me, I mean, from where I'm standing, so the European area, what is very true is that European institutional investors are keeping the stance. So that is very true, and they are even more vocal than in the past on that topic, and indeed claiming publicly that now they are looking for alignment with their asset managers.
Right.
And that is indeed reshuffling actually the market. Not completely, it's, we've seen some example recently, but as part of any tender offer, there is this more and more this alignment dimension that is part, all else being equal, that is taking into account. So this is one thing, and here actually what is indeed the consequence of that is that asset managers have to be clear on their positioning for transparency. So institutional investors can pick the one that are the most aligned with their own positioning. So it's really pushed to transparency. However, I would say that, and from that perspective, it's quite a good thing that we can clarify actually the positioning. Having said that, I think it's important that we are also all in a position to serve each and every client wherever they are, according to their specific needs, and that there are no dogmatic approach in the way we proceed. And here we have to deal with, therefore, indeed a polarized world. And to navigate that, I think the most important dimension, even if it seems a bit obvious, is that navigating such type of environment means substance first. And when it comes, I mean, and climate is all about substance. Institutional investors, whatever their, I would say, objective or positioning, today are more and more concerned about this climate physical risk. Right. How it will impact their investment, financially speaking, how it will impact the stability of the economic system for long-term perspective. This is one thing. So they are more and more assessing transition plan. I mean, corporates are adopting those transition plan, meaning that it will impact trajectory of the corporate company. So it is about assessing the cost of this transition, the viability, but the cost of this transition plan, the cost of not having it, or the cost of partially implementing it. So it's all these considerations that are really economically driven. And finally, indeed, actually all the opportunities that are arising actually from this clean energy dynamic and this notion of strategic autonomy that actually is looking for in each and every region, and that is creating opportunities with associated risks. So everything, I mean, as an asset manager, our role is actually to answer all that questions that are really material questions and substance-oriented questions. Having said that, I would say that navigating such polarized world is also probably actually extra work in terms of interoperability. We have to deal with very fragmented regulatory frameworks, in particular when it comes to disclosure. Yeah. So we have to adapt and make sure actually we can reach highest or more demanding standards and all local dynamics. So this is one thing. And the third element is probably actually to integrate geopolitical risk on the risk map for each and every project. In the past, climate topic that was supported by a strong consensus, so it was kind of risk that was disregarded. Now it should be part of any thinking process or analysis process.
Okay. I guess what I was, one of the other things I was trying to get at is like, do you think global banks, global asset managers can continue to maintain a kind of broadly diversified global investor base if you have investors in different regions with different expectations of their asset managers and their banks, and also the supervisors having very different expectations? Like, if you just look at what the ECB and the Europe is asking of its banks versus what the US is, for example. Like, Sarah, how do you think those tensions can be held together?
So in my role, I sit in the commercial investment bank and I talk to our clients, startups all the way to established companies, and I do that around the world. And our North Star is and always is our clients and what are our client needs and meeting our client needs and what they are. I will add that the complexity of adaptation and resilience, as you were saying, requires depth of work and expertise now that is very unique to the country and to the client of what they need. And like that's part of why I have a job, is to go have those conversations, of these deep conversations, to say, how do we meet this complexity of what you need in this moment? And I think that is why companies and banks have done well and expanded, is because meeting whatever those needs are and those complexities and be able to work for all of the clients and figuring out how to do that. And I think there's now also more of a realization, and it's changed in the way Climate Week has been run this year and the types of meetings that I've been going to, is that people are realizing this is incredibly complex and difficult in a difficult time. And views are shifting on so many things. Like as an example, I will say that from my background doing science, but doing science in the civil agency that supported defense and supported intelligence, I'm now being asked to go to meetings on national security and defense and explain how science can be dual use and climate tech can be dual use. But I'm speaking to groups that otherwise historically would have said, I don't spend money or I don't focus on defense because I've removed that. But now because of geopolitical realities, they're bringing that into the fold. So I think we're in this time where these views are changing really rapidly and people need help seeing through them and strategizing through this complexity. And that is what we are going to have to be doing and spending our time on.
Okay. Now we've talked about the kind of the global picture. But let's talk a little bit about the US. Obviously, I'm based in London, so I have a view in, but maybe it's not an accurate one and you can correct me. But one thing that I've heard frequently is the idea that we are now in an era of green hushing. This is a label that gets mentioned, bandied about a lot. The idea being that finance firms and corporations continue to do the work around climate and decarbonization. They're just not talking about it. And I wonder if this is actually true or if it's a bit of a trope. Like, for example, when Trump was elected, everyone was saying he won't touch the IRA, all the jobs in the red states. And I guess we've seen how that's turned out. And I just wonder if this is another one of those things that people say but maybe isn't true. Now I look at the Net Zero Banking Alliance, which is something I've written about, where you've seen the big US banks leave that. And for the most part, except for Wells Fargo, all have kept the targets that they had. Some have even added more, like sectoral decarbonization targets. So you could say, okay, there is suggestion that they continue doing the work, they're just not talking about it. But I wonder if, there is, maybe in some cases there's green hushing. I also wonder if there's a pretext for slowing down, or what you might call green stopping or green halting. We could workshop a better word, better phrase. Please someone share some ideas if you have one. But I wonder, like, how do you, I guess I'll ask you that first because you're based in the US, but how do you kind of gauge that, the conversations you have with clients and investors?
Yeah, for the last few years, I saw a lot of enthusiasm to do leadership by press release before action actually happened.
Yeah.
And as a scientist and as a technologist, that made me incredibly uneasy about the difficulty of achieving the things that people wanted to achieve, whatever they were within the space. And I think we've been forced to have a reset of that, where companies are now doing the deep strategy to try and figure out, I'm in point A, I'm in point B. Can I get there in 2 years, 3 years, 5 years, 10 years? Which part of my plans is this? And then where does that fit when I make my milestones or my goals of when I'm going to talk about it? Because they don't want to lead by press release anymore. They want to lead by action and dollars and showing that the businesses work. And on that, I kind of said this before, I am a climate scientist at a bank doing advisory work. I'm the only one across the banks doing what I do. And it's because the nuance and request for my time to help people think through physical climate risk and think through policy and geopolitics of climate and broadly the environment of what I used to oversee for the US government, the demand is very high. It's higher than I thought. I'm on the plane all the time. But there's so much desire to have these conversations right now that were not happening before this.
And are those conversations mostly focused on physical risk? I'm keen that we talk a bit about physical risk because you've both mentioned it several times. Is that the main? Physical
risk is a major driver, and the reason it's a major driver is it's starting to be priced into the markets. It's showing up in the insurance markets, and business leaders are like anyone. They have homes and they're seeing their home insurance rates going up. They're starting to see it in their business affecting them as well. And watching both of them, they're concerned about what it looks like going forward. I think people also have a recency bias where the most recent event, they fixate on that and they think about the risk and they need to deal with it. Seeing the level of wildfires that occurred in the Los Angeles wildfire woke up a lot of people about physical risk that they are going to start experiencing that will be different going forward. So a lot of the conversation is around what are my physical risks or my exposures in my business and what do I need to think about strategically going forward. But a lot of it also right now is geopolitics and the intersection on the environment and defense. Because people are realizing that this is something that's not going away. Usually with these national security issues, they only grow and they only have influence. And so people are also trying to look and understand, what does that mean? Because I am not used to investing or planning in this space.
Gotcha. Elodie, would you talk about physical risk? You've mentioned that a few times. Like, what are the kind of conversations you're having? And this is with investors or asset owners. Who is asking you about physical risk and what are they saying?
Yeah, actually, I mean, it's really a early stage discussion, but the concern in there, which is actually climate risk or materializing. What does that mean for my portfolios in terms of financial impact, trying to assess the exposure of the investment to this climate risk. And the level of difficulty that once you have managed to assess your exposure through your direct investment, there is also all the indirect exposures through the value chain of the investee company. So it's all that complexity actually that is part at the core of the conversation.
Right.
And after, it's how to build resilience. And through the portfolio construction, and either a case around adaptation. It's been a while that we are talking about, I mean, for transition and mitigation dimension, bringing private capital alongside the public capital in order actually to match the required needs. And we discuss a lot about investment case. Now discussion is starting on adaptation. Is there a case for private capital actually to be allocated to this topic alongside public fundings, which is the bulk of the financing today.
And what have you found? Obviously, Sarah, I know that you wrote a paper on adaptation opportunities, but it's interesting that the physical risk conversation, there's two sides. There's one like, oh my gosh, like it's coming, it's already here. There's big impairments to assets, houses are going to be burnt down. But there's also, well, some people trying to say there's an opportunity for financing and investment here. We haven't got very long, but like either of you, both of you, like what's the elevator pitch of the opportunity, financing opportunity on adaptation? Who wants to take that?
For me, I mean, it's too early to bring a clear case on that. Even the scope of what we are talking about is discussed. The way to access it. So it's a lot also about innovation on the financial market instrument side, where we will see more and more, I would say, financial instrument actually enabling to get access to that. There are plenty of sectors that can contribute to adaptation. So for me, at this stage, it's more, I mean, not doing any investment advice at this stage. They are definitely a business case, but it's very much I mean, it's so much case-by-case dimension that it's difficult to answer directly. But this is definitely something that is looked at by asset owners. And again, at the same time of first understanding actually what is portfolio risk exposure to that climate risk to properly build this realization.
Sorry, you want to say, let me give you the final word.
I will add to what she said by saying also investment committees, it's now like you look at a project and you need to have a risk-adjusted return for your physical climate risk as you do with inflation or with the debt ratio of something you're investing in. So it's one of many things that needs to be integrated in.
Right, thank you both so much. I had more questions, but we've run out of time. Sarah and Elodie, thank you so much.